Let's say it's January 1999 and you invested 10,000 euros in global stocks. For a year and a half, you would have looked like a genius. Your savings would have kept going up and up to 15,000 euros. But then, disaster. It turns out that you started investing at the worst time in living history, right before the dot-com crash. And by 2003, you would have had only 7,000 euros left of your original 10,000 in your account. But what if you stayed calm and kept investing? Well, over the next 4 years, the market went up 90%, which is fantastic. But then,
nearly 250,000 homeowners are in danger of losing their homes.
Soaring gas prices, falling home prices, and rising unemployment.
well, let's say you didn't get scared by the financial crisis. You waited for the market to recover and you stayed invested for the following years. Well, if you did that, today you would have 59,000 euros in your investment account, 6 times more than what you invested originally, even though you started investing at one of the worst possible times in history. That is the power of investing. I'm Tom Crosshill. I've got almost 2 decades of investment experience, both working on Wall Street and as an investment company CEO here in Europe. And in this video, I will show you the best way that I know to invest your first 10,000 euros. And in order to find the best way to invest, let's find the worst way to invest and then just do the opposite. So here's our first question. If you have some money sitting in the bank, what is the absolute dumbest thing that you could do with it? Well, the worst financial decision is gambling. When you play roulette, for example, every spin of the wheel gives you a chance to win, but on average, statistically, you're going to lose. If you play long enough, you are guaranteed to go broke. Doing that is really dumb. So let's do the exact opposite. Never gamble, never play games where most people lose. And this rules out many popular financial quote-unquote investments which are promoted by influencers and online gurus. Things like day trading, forex, options trading, CFDs, and more. Anything that involves the word trading is just financial gambling. So you don't want to trade with your first 10,000 euros. You want to invest your money instead. And the difference is your time horizon. Trading is all about making quick profits. You buy a stock at 10 a.m. in the morning, you sell it at 10:15, you make a quick profit, hopefully, and then you repeat that. By contrast, investing is about patience. You find some good investments and then you hold them for years or even decades, and you allow them to make you wealthy. Okay, but what are the best long-term investments to choose? I mean, there are many different investments out there which have been profitable over the years. So which is the best? Well, again, let's start with a bad choice and then do the opposite. What if I told you that there's a really popular investment that many people have loved for thousands of years? And 2,000 years ago, if you had roughly 30 grams of this valuable asset living in ancient Rome, you could have used it to buy a cow. But if you didn't spend it, if you kept this investment for 2,000 years, if you kept investing until today patiently, well, here's how your investment would have paid off. Today, 30 grams of this asset could buy you a cow. The true value of this asset has not changed in 2,000 years. And when you think about it, that sounds like a terrible investment, right? I mean, you can't build wealth investing in something that doesn't get more valuable over time. But millions of people around the world swear by this investment, which of course is gold. Over the centuries, the price of gold has increased tremendously in terms of paper currencies like the dollar or the pound or the franc. But after you adjust for rising prices, gold has simply kept up with inflation. Now, sure, the past couple of decades have been great for gold. The price has shot up and up and up. But between 1980 and 2000, gold was one of the worst investments out there. It lost 80% of its value after adjusting for inflation. The reason gold makes a poor long-term investment is that it's a commodity. It's not a productive asset. If you invest in commodities like gold or silver or platinum, well, basically you're buying chunks of metal that are simply going to sit on the shelf. If the price goes up, you earn a profit. If the price goes down, you lose. But this kind of investment will not generate any income for you. It will not give you cash flow. And over the long term, that makes commodities poor investments. Okay, so the second mistake that you want to avoid is investing in commodities, and the opposite is to invest in productive assets which create value. So what are the best productive assets to invest in? There are three major asset classes, three major types of investments that have been proven winners over the centuries. You've got stocks, you've got bonds, and real estate. This step in our journey is going to be an exception because there is no bad answer here. There is no wrong decision between stocks and bonds and real estate. All of these can be really good long-term investments depending on what you need. So in order to make a choice, we need to narrow our criteria. Let's assume that you are a busy European, so you've got a job or a business, you've got family, you don't want to spend a lot of time on investing, so you need something that is passive. And let's assume that your main goal right now is to make your money grow. So you're still young, you've got time ahead of you, and your priority is to make your money grow as opposed to keeping your portfolio as stable as possible. This is going to rule out a couple of choices. When you buy a bond, for example, you're essentially making a loan to a government or a big company. And this can be quite safe. It can be a decent way to make money, but over the long term, bonds have not been that profitable. They often struggle to even cover inflation. So if your goal is to make money, we can put that aside. Now, real estate, by contrast, is a very profitable long-term investment. I mean, if you buy a house or apartment and you rent it out, you get some rental income, it can be quite profitable. But it's a little tricky to buy real estate with just 10,000 euros, as in our example. And also, it takes quite a lot of work to find a property, to buy it, to find tenants, to fix broken toilets. It's basically a second job if you want to have your own real estate portfolio. So if you're looking for a passive investment, real estate is probably not the answer. So that leaves stock investing. And yes, perhaps I'm biased because I teach stock investing, but I really believe that stocks should be the foundation of pretty much everybody's portfolio. Because when you think about it, what is a stock? When you buy a stock, you buy part of a company. And that means that you've got thousands of people who go to work at that company every day in order to make you money. When you invest in the market as a whole, basically you've got millions of people who work year after year to serve their clients and to make money for the company and to make shareholders richer. And over the years and over the decades, this is tremendously profitable. I mean, the stock market has earned an average of 9% per year over the past 50 years. And beginning investors often think, well, 9% per year, I mean, who cares? It's too little. But they don't realize the power of what is called compound interest. Over 50 years, 10,000 euros invested at 9% per year would become 740,000. Over a more manageable period of 20 years, 10,000 would become 56,000, almost 6 times more than you originally invested. Over a single year, if you make 9% on your 10,000 investment, it doesn't seem like a big deal. But after 10 or 20 or 30 years, there's this huge difference between somebody who just left their money to sit in the bank and somebody who invested and got 7, 8, 9, 10% per year. And now they are able to spend 3, 4, 5, or 6 times more than the other guy. All right, so we want to invest in stocks. And then the natural next question is, which stocks do you buy? Because there's thousands of different stocks in the market to choose from. Well, again, let's ask, what is the worst way to do this? And it's probably this. Maybe you talk to your cousin who gives you a hot tip, or you go on Reddit and read a recommendation from some anonymous poster, or you turn on the TV and listen to Jim Cramer who's promoting some stock, and you take 2 or 3 of these recommendations and you put your 10,000 euros into these companies. If you do that, chances are you will lose your money. Professor Henrik Bessenbinder studied 26,000 different stocks in the US stock market over the past 90 years, and he demonstrated that the average stock in the market loses money. As many as 11% of all stocks are complete losses, they go to zero. There's some other research which showed that as many as 40% of all stocks at some point experience what is called a catastrophic loss, where you lose 70% of your money and you never get it back. The reality is that the stock market is kind of a minefield. If you go in and do what is called stock picking, if you try to pick individual stocks and put your money into those, there's a big chance that you will lose your money or at least do poorly. So if that is the worst way to do it, what is a better approach? We know that the stock market as a whole gets good results. So buy an investment fund which invests in hundreds of different stocks at the same time. Now, of course, this is only kind of the answer, because the reality is there are more investment funds out there than there are stocks. You've got literally tens of thousands of different funds around the world. So how do you find a fund that is good for you? Well, again, let's start with a classic mistake. Many people here in Europe don't know what investments to choose, so they go to their local bank and ask the banker for advice. But the problem is, and this is something that many people don't realize, here in the European Union, banks have no obligation to give you the best possible investment. They don't have a duty to take excellent care of you. All they are obligated to do is not sell you something that's completely inappropriate. So when you go to your bank and ask for investment advice, they will typically offer expensive, so-called actively managed funds. And there's decades of evidence showing that these kinds of funds get poor results. You often pay something like 1.5% or even 2% per year in fees. Instead of earning something like 9% per year, you can end up getting 6 or 7% per year, which over the decades makes a huge negative difference. So there are actually two mistakes here. One is going to your local bank to ask for advice, and the other is buying expensive, actively managed investment funds. So what is the opposite? Well, the opposite approach is to buy what are called ETFs and index funds. These are low-cost investment funds which invest in the whole market. They buy a little bit of every stock in the market, and they get you the market average result with a low fee. And there's literally decades of market studies at this point showing that ETFs and index funds outperform the vast majority of other investment funds out there. But of course, even buy some ETFs is not the end of the road, because there are thousands of different ETFs to choose from. So how do you choose among them? Well, the worst mistake you could make here is to think that all ETFs are the same, so just choose something that looks good. If you do that, you might end up buying something that is highly speculative. For example, there are leveraged ETFs like this one, which goes up or down twice as much as the stock market, and this can be quite dangerous. Or you've got highly concentrated ETFs, which invest in a narrow sector or theme, which usually ends up leading to poor results for investors. In most cases, unless you're a professional investor, what you want is so-called broad market ETFs. So these are ETFs which invest in hundreds of different stocks in different industries and different regions. One famous example is VWCE, the Vanguard FTSE All World UCITS ETF accumulating. If we look on justetf.com, which is a great database for finding ETFs here in Europe, we see that this fund invests in 3,600 different stocks around the world. So it's very diversified, and you only pay a fee of 0.19% per year to manage it. And buying this kind of fund is super easy. I mean, you go to an investment app like Trading 212, which is very simple for beginners. You just search for VWCE, you click buy, you tell the broker how many shares or how much money you want to invest, and a few clicks, and basically you're done. Now, don't jump in and immediately buy VWCE. This is just a demonstration. It's not a recommendation. And depending on the country where you live and your individual goals, it could be a bad choice. We'll talk about that in a second. But first, I want to talk about another mistake that is very common. Because let's say you decide, yes, I want to invest in ETFs. You will have a question like, when is the right moment to start investing? Maybe you read the news and you hear about war or political conflict or economic problems, and there's a lot of reasons to kind of feel worried and think, well, maybe I should hold on, maybe I should wait for a better time. So how do you solve that? Well, to explain it, let's again look at the wrong answer. This is what many beginning investors do. Let's say it's 1999. The dot-com bubble is happening. Everybody's talking about the internet economy. You would like to start investing, but you're cautious, you don't want to lose your money, you see some worrying headlines in the press, so you keep delaying and waiting, and in the meantime, the market goes up and up and up. So you delay for a year, then it's 2000, it's a new millennium, so you say, okay, yes, finally, I'm gonna invest. But because you've been waiting for so long, the market kept going up, and now you are buying stocks at an expensive price. And just a few months later, the whole market crashes, and you lose so much money. So then you freak out. You call yourself an idiot. You bought at the worst possible time. Now you've lost half your money. So you sell all your stocks and you run away from the market. And then over the next few years, you see the market going up again. And by 2005 or 2006, a lot of your friends are making so much money from stocks. And finally you give in. You say, okay, yes, I'm going back in. And you invest, let's say in August 2006. A year or two passes and there's another huge crash. It's the big financial crisis and you lose half your money again. Now, maybe you've learned from your mistakes, but maybe not. Maybe you sell again at the worst possible time and lose a bunch of money. And then you wait for 5 or 10 years until the market is way higher and then you jump in again. This happens all the time. This is called timing the market, and it almost always means that you buy stocks when they are too expensive because you wait for too long, and you sell stocks when they are too cheap, when there is a crash because you panic and you feel afraid. Market timing does not work. Any kind of game that you play trying to figure out the right time to put your money into the market is much more likely to cost you than to benefit you. So if market timing doesn't work, what is the opposite? Well, the opposite is don't try to pick the right time to invest. You simply start investing today and you keep investing ideally every month, no matter what happens in the market, no matter what news headlines you see. Somebody who started investing in January 1999 and kept investing every month through the dot-com bubble, through the big financial crisis, through the Obama and Trump and Biden presidencies and COVID and everything else, would have earned around 9% per year for their trouble, just because they were not afraid to start investing and keep investing every month. And if you can learn this simple lesson, if you can stop fearing market crashes, stop trying to guess the right time, chances are your long-term result will be very, very good. Okay, but here I must come back to a mistake that I mentioned earlier, which is when you go online and you read a blog or watch a video like this one, maybe you hear that somebody recommends an ETF like VWCE, and you blindly follow instructions and put your money into this fund. In some cases, that could be a good decision, but there are many potential problems with this. First of all, there are 30 plus different tax systems across Europe, and in every European country, the best ETFs and index funds can look a little bit different. An ETF that can be a good choice in Spain can be a poor choice in Austria and vice versa. Second, everybody's goals and risk tolerance is different. Some people are all about maximizing gains and they are okay taking significant risks with their portfolio. Others have built up a large nest egg over the years and maybe you just want to keep it as safe as possible. Depending on that, maybe you do want to put 100% into stocks, but maybe you want a portfolio that is more conservative with bond ETFs to keep the risk level lower. And then you also have to realize that an all-world stock ETF like VWCE invests around 60% of your money into the American stock market. And looking at today's geopolitical situation, a lot of investors don't want that. The mistake here is taking one-size-fits-all investment advice and applying it to everybody in Europe. If you really want to succeed with ETF and index investing, you should pick a strategy that matches your age, your goals, the level of risk you're happy with, and the tax rules in the country where you live. Now, in this YouTube channel, I solve these problems one video at a time. But if you'd like a simpler solution, a training which includes one-on-one support from me to answer all your questions, then you might enjoy the Index Masterclass, my training program for European investors. With this program, I've helped thousands of people all over Europe become investors over the years, and I'd love to help you too. So if that sounds interesting, follow the first link in the description.